Okay, welcome back to our conference, the 23rd Annual Greek Marine Money Ship Finance Forum. Hope you enjoyed your lunch. Thank you very much to TEN for hosting it for us. This afternoon we're going to be talking more about finance and also about ESG. Our first session is about the capital markets. We've entitled it Share Prices of Certain Shipping Companies Have Steamed Ahead. Will this lead to more active capital market activity? Our moderator is Mr. Rob Lustrin, Counsel, Transportation Industry Group of ReedSmith. Rob, please.
Kevin, thank you. And I'm very happy to be here at the 23rd Annual Marine Money Greek Ship Finance Forum. I remember the first Greek Ship Finance Forum, and Kevin and I look exactly the same, which is terrific. And we spoke a lot then about high-yield bonds and diversified companies. It was a completely different time in a completely different market. So we're here to talk about what's going on in the capital markets in 2021, hopefully in the post-COVID era. Great to be back in Athens, by the way, and thanks to all of you for coming today. Very exciting to have an in-person event, as we've all been saying, and I thank all of my friends here in Greece for their great hospitality. And of course, thank you all for creating the great shipping fundamentals, which is helping all of us, to be here today and to speak about very positive developments, both in the shipping markets and in the capital markets. So I'm now with ReedSmith. As you know, many of you have driven by our office across the street here on Spyrou. We have 30 offices around the world, and I'm very happy to represent our firm here at Marine Money. I think I'm truly blessed to be here, as we all are, in this post-COVID era, and hopefully it will be post-COVID. So our topic, as Kevin pointed out, are the capital markets, and more specifically, whether the solid and consistent stock prices that the shipping companies that are listed in the United States have seen in the last a couple of months, last several weeks, consistently solid, even in the face of volatility in other sectors, whether that will translate into financing activity in the capital markets. So let me introduce our panel to you, who are all great experts in various fields. We have at least one banker and some owners here, get their perspective. So let me introduce them to you now. Jim Cirenza, he's our banker, Managing Director of DNB Markets, been around shipping just about all his life, and thank you for coming, Jim. Simos Spyrou is on the end. Simos is the co-CFO of Starball Carriers Corp. Next to Jim, Aristides Pittas, who is the chairman and CEO of both Euroseas and Eurodry. Harry's Kosmatos. What's your title, Harry? I don't know if I have a title here. Harry's is with Tsakos Energy Navigation, and also, as long as I can remember, been in and around shipping and capital markets and has a very long-term perspective. And of course, Anthony Argyropoulos of Performance Shipping, also of Seabourn. And Anthony, thank you for coming. And Anthony also has a great long-term perspective, as he was involved in some of the earliest shipping IPOs in different iterations of his life. So why don't we just take the next step here, get right into the questions. I think the question that we're hearing most when we come to Greece and what people are speaking about is, where are we in the cycle, and is it even possible to get an IPO done? And I'd like to hear your thoughts of that. And Jim, maybe we'll start with you. Is that possible, and is it different this time?
Let me take this. Is it different this time? I'm always amazed by short memories. And so in conversations just sort of 2 years ago with investors versus in the last 12 months, I remember doing a tour of ESG funds 2 years ago, mostly in Boston. And they were telling me, we'll never touch anything that ever touches carbon. And then they come to me last year and they say to me, Jim, find me the best house on a bad street. You know, after 11 years of growth destroying value, value's had a pretty good year versus growth. So Yeah, the hedge fund community's been the biggest uptick in terms of new investors to the space. The mutual fund industry has thrown back some industry and transportation analysts that take shipping seriously, and family offices in Europe have picked up a bit. So the perspective is different this time. I'm finding enough people that give me hope that it is different this time. So I'm going to tell a bad joke that I told on a college recruiting trip about 37 years ago. And so pretend you're in a church in California, you're standing at the altar, and either Elizabeth Taylor or Zsa Zsa Gabor is walking up the aisle, and you're about to be husband number 7. So history would say you're going to have a little less than 2 happy years, but you're there because you think it's going to be different this time. And so I'm in the same camp with those investors who think it's going to be different this time.
Jim is obviously not speaking to New York Yankees fans. That's
I am a Yankee fan.
Thanks for that, Jim. And maybe, Anthony, maybe you have some thoughts. Is it even possible to get an IPO done these days? And what can a private owner do to maybe align themselves? Are there anything that they can do if they choose to move down that road?
Yeah. Well, I'm not going to talk about the practicalities of financial statements and the SEC process and all, which is kind of like a 6-month proposition. The main challenge right now, and it is different because mainly most of the companies trade below net asset value. In other cycles, like when we had the big boom in the IPO market in the early 2000s and mid-2000s, the stocks were trading at a premium. So there was a huge incentive for companies to actually go public. In today's market, I think the biggest challenge is not necessarily, and I'll go to that, whether the capital markets are there to go public, but whether the valuation is there at an attractive level for the owners. In terms of the IPO market, there's a big bifurcation of the public companies. You have the very large, for shipping standards always, market caps, and investors are much more geared towards those. And you also have the much smaller companies that where the long-only institutional interest is not there. So I think in today's market, I would say that it's quite challenging for a company to go public.
Simo, perhaps you have some thoughts, being from one of the larger, more prominent listed companies today.
I echo Antonis' views, fully agree. Basically, when you have in a market the vast majority of the companies trading at a discount to NAV, it's going to be very difficult for new entrants to justify valuations at NAV, because I presume that all, companies that would like to do an IPO right now would like to do at least at NAV. So the concerns raised by investors would be basically, why should I buy a new entrant, a new company, a smaller platform, basically at NAV, when I can find plenty of alternatives, public companies at such discounts right now. At the same time, another consideration is consolidation. We've seen that investors during the last few years are favoring consolidation. So they should be asking, why would, what's the alternative proposition for a smaller new platform to enter the market and achieve such valuations when I can have, bigger platforms already public. What we have done in Starbucks, and I'm finishing, during the last 3 years is just an alternative. We've offered to private, smaller platforms, mainly controlled by PE funds, to get their ships for shares, which was an alternative for their exit strategy, instead of doing an IPO to buy their vessels, offer Starbucks shares, do a transaction at NAV to NAV, and basically give them the opportunity to have a liquid currency.
Aristides, you've brought a couple of companies to market. How do you feel about whether or not you think that's something that's even possible in today's environment with the fundamentals that you see. And secondly, if you had some thoughts on what you would advise someone who would be following your lead.
Well, the things are changing. They are different this time. And the biggest difference this time is, as already been said, that we have enough listed companies already. There are a lot of listed companies in all big sectors of shipping, and therefore any investor who wants to invest can easily invest in those entities, and I really don't see why they would invest in a new IPO. So I think it's very difficult now. It was much easier in the past. Simply that.
Haris, maybe you have some thoughts as well.
Well, perhaps I think it's probably more pertinent if I change your question a little bit and say, and ask, are investors today willing to take an equity risk in a company, either through an IPO or an alternative source? Through the IPO, probably not, and probably not in the sense that the owner might not be receptive to the calls of the investor, because the valuations that the investor would want to buy that stock will not be very interesting for the owner. On the other side of the equation, however, we do see over the last year, especially obviously on the containers and the dry bulks, that they have gone 5 times, 10 times more their values of over a year. At that point, those kind of investors, I think, are beginning to get more interested in shipping, and they would be willing to take more of an equity risk in an existing company that has a track record. They know how the company has operated and performed stock-wise, during the cycle. And it's more tangible for them, so they can take a position on an existing player. As Aristides said, there are too many players in the public markets for them to choose. I don't think today it's I would dare to say right to open the floodgates and everyone to start listening again, because we all know what has happened in the past. Both in containers and dry bulk, I think investors to go for the big IPOs, for the transformational IPOs, if you like, they need the big institutional investors. They need to see some sustainability on those elevated prices, because if they believe that they are only here for a year or two, I don't think that's enough to whet their appetite to do. To go through the IPO. Through an existing companies, they can go in and out in a much quicker fashion.
Thank you, Haris. Anthony, let me just roll back to you a little bit. What do you see as happening now in terms of potential, utilization of the capital markets, such as maybe doing a spin-off or something like this? Are we seeing that kind of activity just generally around? Are you hearing about these type of things? And if so, is it something that public companies should be thinking about?
Yeah, I think the spin-off is certainly one transaction that we have seen. Aristides did this, I think, a couple of years ago or 3 years ago, with the spin-off of the dry bulk company, effectively, to Eurodry. It's a way to incubate, to use a public vehicle, and in short, effectively, it's a dividend of a subsidiary of an existing public company to its shareholders. So the subsidiary becomes yet another public company. As a matter of fact, yesterday we saw Diana Shipping filing for such a transaction. There are more coming that I know of. And it's certainly a way to create another public vehicle, to grow it independently, particularly if you have different asset classes within one shipping company. So I think that's another venue. The SPACs, which have been very, very proliferate the last few years, unfortunately do not lend themselves to mergers or de-SPACing transactions with shipping companies. So unfortunately, that has not been an alternative, again, because of the poor valuation, below net asset value, that is. And as I said before, we have to look at the capital markets and public shipping companies and see that size matters. If you have a fleet of 50 ships, and for some reason you believe that you can, for estate planning purposes mainly, list, I think you could tag along to the larger companies that have a smaller discount. But I think the transactions that I did quite a few of them in my career, where you take a small company and make a transformative acquisition with the IPO and end up with a fleet of 10, 15 ships, I think that's going to be hard to emulate.
Thank you, Anthony. Aristides, perhaps you can comment a little bit on that in light of the Eurodry transaction, difficulties involved and
Sure.
timeline, that kind of thing.
Sure. I try to be specific when I'm answering the specific question. So I talked about IPOs when you asked me about IPOs. Spin-offs or mergers is a little bit different, and I think that is happening as we're seeing. It can continue happening, and I think it will continue happening. It's funny because right now what we're seeing in the market is some companies spinning off the different sectors, other companies combining the different sectors into one. So there is a debate there on what is the best thing for the public markets. Personally, through the experience we had by having a mixed fleet company, which was listed in the public markets for many, many years before we spun them off, we thought that was a great idea initially because we knew that shipping is a very cyclical business and a high-risk business, and we thought investors would prefer the stability offered by the fact that you can combine different sectors and somehow reduce your risks. So that's why we decided to do the spin-off when we found out that really what investors wanted was to choose themselves the sector they would be in, and that finally the investors, at least the investors in shipping, are more gamblers, I would say, than low-term investors. I think the majority of the shipping investors like to go in and out of stocks and buy the shares low and sell them high, and that's the more important thing for them. And now most of them understand the difference between a dry bulk vessel and a container vessel and a tanker vessel. I still remember something that Nikos Tsakos had said when we first went into the charter, into the shipping markets, in the capital markets. He said, I have a sheep vessel, and they thought I was carrying sheep instead of being a ship. So now the investors know the difference. And to my mind, I think that we will see more spin-offs materializing.
Now we carry containers or tankers.
There you go. Well, Jim, this is a great question for you. You know, years ago, and I think there was the conventional knowledge back in those days may have been that a diversified shipping company across sectors was actually a benefit in having more of a stable revenue stream through the cycle. Is that something that may become attractive again? Are we looking for something like that? Or are investors still singularly focused on a specific sector, or even within a sector, a specific, asset class in terms of size, deadweight or TEU in the case of containers?
So the single asset class shipping company, the historic notion over the last 20 years that they perform better, they price better to NAV, that data is kind of overwhelmed by a couple of companies with strong owners that can underwrite their own deals, and they pay out very generous dividends. So the Frederickson companies and the BW companies tend to have traded better in terms of price to NAV. And I think people focus too much on single asset class versus multi-asset class as opposed to what was the difference in the dividend policy. You look at the frontline dividend policy of the decade of the 2000s, and they spun off the dividends were a multiple of the value of the company, and they spun off Ship Finance. So you look at the companies, once again, I think we get too focused on history says single asset class groups trade better and multi-asset classes trade worse. I'm not convinced that's the case, and I'm not seeing as much focus from investors now versus 10 years ago that the single asset class is the way to go. And frankly, there's some single asset class shipping companies that aren't around anymore because the volatility got them. If you're in Nicholas's and Harris' perspective, the fact that they had LNG was really useful at a point in time or two. So you've got to survive as well.
Harris?
I think spin-offs should not be done without a lot of thought going into the equation. They could be dangerous. There is a lot of risk, and I will explain why. And you could be putting yourself in a very precarious situation, especially when the markets desert you. They do make sense for diversification purposes to isolate certain asset classes and offer investors a different kind of product. However, you need to make sure that investor interest is there in the long run. You get the sticky money, not the day traders that will play your stock. They will like your story for a month or two, a year, and then they will desert you. Because if you do not have scale, if you have spun off a certain asset class of your fleet, an investor interest dissipates over a period of time, you are left with a very small fleet in the public markets that you cannot do anything with. And at some point, you will need to do, perhaps, to bring it back into the fold. So you could be putting yourself in a very kind of slippery slope, and a lot of thought needs to be taken before you spin off an asset class, especially if it's only for a few vessels.
Thank you, Harris. Simos, we were I guess Jim was speaking a little bit about dividend policy. I know at Starbulk there was, I don't know if there was a change in the policy, but certainly you have started to pay some dividends through Starbulk. I'm just wondering if you can comment on Jim's thought. Obviously, Starbulk is a single sector company and does have that component now. Do you have any comment on that, or something that you can help the audience understand the interplay between what you're doing and how you see that versus maybe some of your competitors?
I tend to be somewhere in the middle. I agree on the one hand that investors prefer to see single asset vehicles and not multi-asset vehicles. But on the other side, I fully agree with Harris and Jim that size is important. So it's the volume, the liquidity of two smaller vehicles are not preferable to a big, large vehicle. So it's a combination both on the one hand of preference of investors to let them choose the platform that they would like, the favorable platform they would like to invest to, and on the other side to provide liquidity and size on that platform. Now, coming on the dividend story that you have asked, basically we have decided, basically decided to keep a minimum liquidity per vessel, which is approximately 1 year worth of debt service, and above this liquidity, basically to distribute all cash flow as a dividend. And this is primarily, towards attracting yield investors and retail investors, which we have gradually started seeing on our stock recently. However, on the other side, we haven't seen our stock being valued as a dividend yield. So we still see investors valuing the stock, at the percentage of NAV, and rather than the dividend that is being paid and the potential dividends that are coming during the following quarters.
Thank you, Simos. I wonder if Aristides has also maybe a comment on whether, going forward, whether the investor base is changing more towards yield-driven investors rather than growth-driven investors, and whether you think, as I said, going forward, you might, I don't want to prognosticate about what you're going to do in terms of a policy, but what you're seeing in the market generally and like.
Well, in the, 17 years that I've been involved in the capital markets up to now, the discussion about dividend versus growth has been going on forever, and there have been periods where one was seeming to be winning and the other was losing. So this is something that I think is also cyclical and it will change from time to time. Of course, it also depends on the type of company that you have. I would think myself that single asset companies, which are going to be more volatile than the other companies, than the mixed fleet companies, because those will be able to be more balanced, with the advantages of being more balanced, but the disadvantages of not being able to offer the huge returns in growth and improvements in price. So it's a balance always. It's really a balance always. I think the important thing that every company has to really consider is the best use of capital at any point in time. And I think that the investors in all companies, no matter what size the company has, is that they want the company to be growing. I think that is something that is inherent in investors always. They want to see a growing company. But of course, not a company growing with deals that are not accretive. So the difficulty in a high market is to find what deals you can do that will continue to be accretive and do those rather than pay dividends, which is difficult, and therefore dividend might be a solution.
Harris, it looks like you have a comment
on what Aristides and actually what Simos, who raised a very interesting point. Aristides is, I think, describing an ideal scenario in shipping where investors have the knowledge to invest in companies that can either grow or pay the dividend and decide which, what do they need. The important point that Simos mentioned was that they pay a very healthy dividend, but they do not get valued as a dividend player. They don't get any credit out of it. And unfortunately, today, at this juncture, investors are in their majority, if not in their entirety, day traders, short-term investors playing the volatility of the stock. So they don't care, they don't pay you a single dime extra if you give even a double-digit dividend yield. They wouldn't care. They will just play on the volatility of the stock because they are in and out, and they will get, they will play the market and they will exit. And again, the example of the container and the dry bulk companies that they were, they have increased like 5-fold, 10-fold since this time last year. These investors are no longer around for the next part of their investment. They are doing chicken farms today. So we need to see the sticky money. We need to see the big institutionals coming back in to provide the platform for a little more sensible trading, if you like.
Thank you for that answer. I just want to shift gears a little bit. Now we've heard a few cases now where we've seen in the Greek market some unsecured debt right here in Greece. And I'd like maybe each of the panelists could say a couple of words about their focus on and expectation on the availability of capital markets debt products, and in particular, whether we think that the deals that we'd be seeing here in Greece may continue. I think that's quite interesting. I don't know who would like to take that first. Maybe Jim?
Yeah, but I'm going to skip the Greek unsecured bond piece of it and just talk about a little bit about bond piece
Sounds
of it.
good.
One thing that I'm very encouraged about, so you take this green bond market, which is a little bit more than a decade old, and if you had asked me a year ago, do you think you'll ever do a green bond or a sustainability-linked bond for a shipping company? I would have said a year ago, probably no. And we've already done 3 sustainability-linked bonds for shipping companies. We've done it for Seaspan, we've done it for Ogfield Shipping, which is a chemical tanker company. And so the ability to raise either more capital or get a slightly better coupon as a result of doing one of those appears to be worth the effort to just distinguish yourself relative to the pack, go through the efforts with a Sustainalytics or an MSCI, get yourself a rating. It seems to be worth the effort, and I'm happy that what has been a big bond market for a decade now, that shipping is starting to make some inroads into. That being said, shipping bonds are getting done in the US, they're getting done in the Nordic region, they're getting done in Europe. In a world where high yield isn't high yield anymore, and US high yield is what, 4%-ish, a shipping bond starts to look very attractive on a relative basis.
Simo, maybe you have a point of view on capital markets debt. I know that I think your company is primarily equity funded. But in terms of capital market debt, how do you feel about what's happening here in Greece? And also, is this something that you see as a growing market and something that some of the listed companies that are represented here might start to see presented to them as more cost-effective alternatives than the equity, which seems expensive on an NAV basis?
Well, the Greek debt capital market is finally, after many, many years of trying, basically, is active. We've seen the first Greek bond, basically, shipping bond, being raised earlier this year. Second one is currently marketed. I believe the books are closing today. I'm hearing that there are at least another 2 or 3 peers on the pipeline to follow in the Greek market. Obviously, it's open to the Greek-based companies. It's not an international market, but it's something which is very competitive at extremely competitive terms versus especially the US market. Just to remind that the baby bond that Starbulk basically had and we repaid earlier this year had a coupon of 8.3%. We are talking about coupons less than 3% here in the Greek market. Even if you add the cost of the swap, it's almost half the cost that basically you have in the US. The Norwegian market is somewhere in the middle, I believe, right now. Yes, the Greek market is active and it's quite competitive. Now, in terms of Starbulk, we are currently on a deleveraging mode. So basically, the reason that we have not tapped yet the Greek bond market, despite these attractive terms, is actually because we are trying to reduce the debt, to reduce expensive financing. We are able in this market today, with this size, basically, to get secured financing at terms below 1.8%. So when you have such terms on your secured debt and you do not really need additional financing, this is the only reason for for us not tapping the Greek market.
Thank you for that. Anthony, maybe you're seeing something a little bit
yeah,
different,
I would like to turn the discussion a little bit. I mean, obviously, when we talk about capital markets, it's capital markets, right? It's equity, it's debt, converts, what have you. And certainly being public, as we've seen, recently here in Greece, it gives you alternatives, access to alternatives that you wouldn't have as a private company. both of the companies that access the Greek market here, for example, are listed companies. Having said that, and turning back the discussion to where it started, which is the valuation, I would say that in my mind, I think the biggest challenge that the industry faces is that we have taken the private model, the private shipping model, and copied it in the public markets. And I will make the following parallel. We all know that there are ship owners, families that have been in the business for many years. They went through cycles, and they made, some of them succeeded through the cycles and made a lot of money. So what are these families effectively? They're long capital, right? And what are the capital markets? They're long capital. But these families typically, they have a fleet of vessels that are usually debt-free, and effectively they hold these assets through the cycle. And we all know the cycle is 8 years of poor performance or neutral performance at best, followed by 2 years of super performance that nobody can predict in any case. So I think the valuations will be much higher for everybody if the capital structures were inversed. And instead of having a lot of debt and an equity market cap that's usually several hundred millions of dollars, and in some cases like Star Bulk in excess of $1 billion, which still for American standards, it's peanuts. We should, on the other hand, take advantage of the fact that our assets are actually it's an asset-based business with the assets being quite expensive. So if you don't have a lot of leverage, you can have an enterprise value that's effectively your equity market cap in, $2, $3, $4, $5 billion. And I think that's when, and it's a much more sustainable exercise, because obviously through the cycle, you have your ups and downs, but you don't end up in bankruptcy or breaking covenants or having the banks, put undue stress to the company. So I think talking about debt is nice, but we should also, I think debt is one of the culprits that has resulted in low valuations in shipping.
Thank you, Anthony. I was thinking a little bit about what you said earlier, Jim, about so-called sustainability, securities, green bonds, and the like. And I'm just wondering, where are we going with it? Is it something that's sustainable? Is it here to stay? And I know that the public companies are very forthright about their policies in terms of ESG. And I wonder whether that translates into financing. And if so, is it a flash in the pan? Is it a trend? Or do you see this really laying out on a long-term basis?
Listen, every time you get a rainstorm, or high tide, there's always a peak in the tide. There's always a peak in the water level. And you think about the rate of change. We can all look at the graphs of assets under management in Europe, which looks like this for ESG investing, and in the US it kind of looks like this. We can all look at those graphs, but in terms of rate of change, so you just look at the trajectory is slowing down. I think the impact from ESG is a big part of the reason why growth outperformed value. When you think about value, it's energy, it's materials, it's industrials, which includes transportation. The gap a year ago between, I'll give you a funny little example. You take the S&P 500 a year ago, and you take the 100 cheapest companies out on a PE basis, you take the 100 most expensive companies out. So the cheapest company, so now we have an S&P 300 right in the middle. Cheapest company was on a PE of 10, the highest company was on a PE of more than 30. The valuation gap that we were looking at a year ago, call it Labor Day a year ago, was the widest in history. It was wider than the year 2000. The impact of ESG was so severe in the last several years. It's driven both the debt and the equity markets to price value versus growth, or ESG versus non-ESG, to levels that you and I never would have dreamed. And I just think that peak of the wave is behind us now. And like that little comment I made about the ESG guy who would never touch anything that touched carbon, and now he's saying, Jim, find me the best house on a bad street. I'm getting a few more of those phone calls.
Thanks, Jim. Aristides, I'm wondering whether you're seeing something a little bit different from your point of view in terms of whether this will really be something of a long-term basis, and how would it translate into a shipping company? So for ESG purposes, does that translate into alternative fuels, or does it translate into something different for you?
Well, I think for sure the world will decarbonize, and this is something that will happen. But it will not happen on a straight line trajectory. It will happen with ups and downs. It's going to be a very cyclical and strongly changing process, and I think we've seen it already. I mean, just see what we were saying about carbon just 2 months ago, and now everybody, Germany, China, are starting to put up plants that use coal. Again, coal has gone up 400%. We have a lack of it. This is going to be a seesaw change. It will happen. Eventually it will happen. We all should want it to happen for our environment and try and help to do it. But there is a lot of rhetoric which is just to say it rather than the actual actions that have to be done. But it will happen.
Well, my observation is that the shipping industry has actually been at the forefront of environmental safety and protecting the environment over the years. Harris, perhaps you have something from your point of view on the same topic.
Actually, you stole my thunder, because I was about to say that shipping is on the forefront of of environmental changes and innovation, and starting with the OPA 90 back in 1990. Particularly shipping being the least of the polluters in the industrial world. Yes, we are all supportive. We are all aware of what we need to do and what needs to be done going forward. However, you need to have a sustainable business. You need to make sure that you're going to carry the cargo safely from point A to point B. And you cannot do that by having a gun pointed at you. Yes, certain benchmarks need to be set. We need to work within a certain kind of time frame, but we should be allowed some leeway in order to be able to to move and innovate and transform the company. Because today everyone talks about XYZ vessel, type of vessel that would be the ideal. However, in 10 years, that vessel might be obsolete. People talk about zero carbon in from 2050 to to 2030. 2030 is only 8 years ago, 8 years away from today. Taking the vessel today from the yard, in 8 years, the vessel, a net-year-old vessel, it's a super young vessel that has another 10 years of life ahead of it. So we should always be very sensitive on that. We cannot force we cannot force companies to make a mistake just to respond to potentially short-term and not well-thought principles, because these kind of principles are ever-changing. And
Anthony, if I might just ask you for a second. So how do we take that story and help our Greek shipping companies and our public companies to be viewed in the public markets and by capital markets investors as the green alternative?
I guess I get the easy question, huh? So, one thing that I would say is that, first of all, the industry, as Harris has mentioned, has done a lot and is continuing to invest a lot in all these technologies and compliance and regulations. I mean, all the years that I've been in, it's a constant barrage, if you will, of new requirements, capital expenditures, etc. I think perhaps the industry, I would say, in terms of a lobby, in terms of global organizations, could possibly work harder to promote that image. There is also the notion sometimes that, these are rogue ships going around the world and nobody's paying attention to them, which is, of course, much further from the truth. But I would say that I'm not so sure that at the end of the day, the capital markets are that sensitive to whether we are compliant, that they do understand that we are compliant, that we abide by the regulations. I'm not sure that that would have a big impact on valuations, frankly. But in any case, it always never hurts to promote the compliance and environmental compliance and the sustainability of the industry.
Simos, maybe you can have, we just have a few minutes left, maybe we'll give you the last word on this topic.
No, just to add to, one other side to what Anthony just said. Yes, capital markets investors might not be yet that sensitive, but I believe going forward they will start getting more and more sensitive on that, to the extent that when they have two alternatives to invest, similar platforms, similar, size, similar earnings, they will tend to prefer the platform which is more ESG friendly and the platform which has a lower, carbon footprint and, whatever. So when you have to choose between two, obviously, investors will be more sensitive. Obviously, on the other side, if, an alternative would be, a platform that has, much more potential, higher growth, higher earnings potential, that might be the case what Anthony just said. But, comparing between similar things, I think that investors will differentiate and will prefer the more sensitive ESG companies.
As long as they water down the return expectations.
Well, thank you, gentlemen. That was a terrific panel. And I hope that we can meet here again and do this very soon in front of an even larger audience. So thank you, Kevin, and the Marine Money team.